Today in this video, I will tell you about how to avoid emotional investing. So let's start the video without any delay. It is essential to monitor a portfolio in order to navigate the shifting tides of financial markets. Individual investors must also manage emotional buying and selling, which can result from the market's fluctuations. Investors seem to be able to buy investments at the tops and sell at the bottoms. This is because investors are often entangled in media hype and fear. How can investors manage volatile markets while still maintaining an even keel and ensuring that their portfolio is diversified to ensure the highest overall returns in all market conditions? It is important to understand why investors feel euphoric or depressed and avoid falling into investment traps that could lead to poor decisions. Bull vs. bear markets. Bull markets are when markets rise relentlessly and sometimes indiscriminately. Investors might be compelled to explore new markets or hear about opportunities from other sources, news stories, family, friends, or coworkers. Investors might be motivated by the excitement to make gains in bullish market situations. Investors can also be influenced by negative news reports and stories about the economy. This can lead to selling. Investors should be aware that bear markets are always around the corner. They can have a negative impact on their investments and can come with many caveats. Bear markets often arise from rising interest rates, which can encourage risk-off trading and a shift from more risky investments such as stocks to lower-risk savings products. Investors can find it difficult to navigate bear markets when their equity holdings are losing value and safe havens offer greater returns. It can be difficult to decide between buying equities when the market is at its lowest or investing in cash and interest-bearing assets. Investor behavior. Many studies have focused on the behavior of investors. Numerous theories are attempting to explain the regret and overreactions that buyers and sellers experience when it comes money. The truth is that investors' psyches can overwhelm rational thinking in times of stress. This could be due to euphoria, panic, or both. It is essential to take a rational, realistic approach when investing. A non-professional investor will often invest their hard-earned money in investments to earn a return. They still see the market changing at times and their investments losing value. These losses can lead to stress and second-guessing. This is why many investors are able to tolerate losses when investing. It is difficult to lose money. Risk can be seen as a guidepost to investing and investor behavior. An investor who has a basic understanding of the risks associated with investments can reduce the emotional impact of investing. Emotional investing can lead to problems if investors perceive higher stakes or unidentified risks. Time-tested theory. Historical money flow analysis has proven that market participants tend to buy from the top and sell from the bottom. Historical money flow analysis examines the net flows of mutual fund funds. It often shows that buying and selling are most prevalent when markets hit peaks or valleys. A crisis or market anomaly can serve as a useful observation window. During the 2007-2008 financial crisis, investors pulled money out of the market, and money flowing to mutual funds became negative. The market bottom was the peak of net outflows. As is the case with market bottoms, selling led to overly discounted investments that eventually became the foundation for a turning point. Bad timing. Emotional investing can lead to poor market timing. The media reports can help investors spot changes in bull and bear markets. Investors can also benefit from the buzz created by the daily stock market reports, which feed off the activity throughout the day. Media reports can be inaccurate, short-lived, or based on rumors. Individual investors are responsible for their trade decisions. Investors must therefore be careful when trying to time market opportunities using the latest headlines. To evaluate investment opportunities and avoid bad investment decisions, it is important to use rational and realistic thinking. Emotional reactions to breaking news are a sign that your decisions are not based on rational thinking. Strategies to take the emotion out of investing. Two of the most popular approaches to investing: dollar cost averaging and diversification, can take some of the guesswork out of investment decisions and reduce the risk of poor timing due to emotional investing. The dollar cost average of investment dollars is one of the most efficient. Dollar cost averaging refers to a strategy that invests equal amounts of money at a predetermined time. This strategy is applicable to any market. Investors are buying shares at lower prices in a market that is experiencing a downturn. Because the dollar investment is fixed, fewer shares are bought when the share price rises. Staying true to your dollar cost averaging strategy will be key. If there is a significant change, don't alter the strategy. This strategy works best for 401 plans that offer matching benefits. A fixed dollar amount is taken from each paycheck, and the employer contributes additional funds. Diversification is buying a variety of investments rather than one or two securities. This can help reduce market volatility's emotional impact. There are very few times in history where all markets moved in unison, and diversification offered little protection. Diversification strategies can provide protection in normal market cycles because losses in certain investments are offset with gains in others. Diversifying your portfolio can be done in many ways. You could invest in different industries or geographies and hedge with other investments such as real estate or private equity. Each investment group has its own market conditions, so a portfolio that includes all of these types of investments will provide protection from a variety of market conditions. Conclusion: it is not easy to invest without emotion. However, there are important things that investors can do to avoid chasing unrealized gains or panic selling. It is important to understand your risk tolerance and the potential risks associated with your investments in order to make rational decisions. It is important to be able to understand the market and the forces that drive bullish or bearish trends. While there are times when emotional and active investing can be profitable in certain situations, data shows that a well-defined strategy and sticking to it through market volatility often result in the highest long-term performance returns. I hope you liked this video. There are some best online money-making offers given in the description below, so don't forget to check them. If you liked the video, then like and share it, and give your opinion through a comment. If you haven't subscribed to this channel yet, then do it now, and also press the bell icon so that you can get notifications of my future videos. Thanks for watching.